Treatment of foreign partnerships for UAE corporate tax purposes. Overview of foreign partnerships. A foreign partnership refers to a business arrangement formed by two or more individuals or entities, referred to as persons, that come together through a contractual agreement. These partnerships can take various forms, such as traditional partnerships, trusts, or other similar associations of persons. The key characteristic of a foreign partnership is that it is established in accordance with the laws of a foreign jurisdiction, meaning that the partnership is governed by the legal framework of the country or territory in which it was formed, rather than by the laws of the UAE. Under the UAE corporate tax law, the tax treatment of a foreign partnership is not straightforward and depends on certain conditions. In particular, foreign partnerships will be treated as unincorporated partnerships for the purposes of UAE corporate tax if certain criteria are met. This distinction is significant because it determines how the foreign partnership and its partners are taxed within the UAE jurisdiction. Conditions for foreign partnerships to be treated as unincorporated partnerships. For a foreign partnership to be treated as an unincorporated partnership for UAE corporate tax purposes, the following conditions must be satisfied. 1. No taxation in the foreign jurisdiction. The foreign partnership must not be subject to tax in the foreign country or territory where it was established. This means that the foreign jurisdiction where the partnership operates should not impose tax obligations on the partnership as a legal entity. The partnership must not be considered a taxable entity in its home jurisdiction. Instead, the taxation responsibility must lie with the individual partners. Two partners are individually taxed. Each partner in the foreign partnership must be individually subject to tax in the foreign jurisdiction based on their distributive share of the income earned by the partnership. In other words, the foreign partnership itself should not be taxed as an independent entity, and the income from the partnership should be taxed on a flow-through basis, with each partner reporting their share of the partnership's income on their own tax returns in the country of formation. This is important because, for the foreign partnership to qualify as an unincorporated partnership under UAE corporate tax law, the partners, not the partnership itself, must bear the tax liability on the income generated by the partnership. The foreign jurisdiction must allow this type of tax treatment, and the partners must report their share of income for taxation individually. These two conditions ensure that the foreign partnership does not have a separate taxable personality in the country of its formation, and that its income is allocated and taxed based on the partners' distributive shares. As a result, the foreign partnership will be treated in the same way as a domestic unincorporated partnership under UAE tax law, where the partnership itself is not subject to tax, but the individual partners are. Annual declaration requirement to the Federal Tax Authority, FTA. In addition to meeting the above conditions, the foreign partnership must fulfill certain compliance requirements under UAE tax law. Specifically, the foreign partnership is required to submit an annual declaration to the Federal Tax Authority, FTA. This declaration serves as a formal confirmation that the partnership meets the conditions necessary for it to be treated as an unincorporated partnership under the UAE corporate tax framework. The annual declaration must confirm that the foreign partnership does not pay tax in the jurisdiction where it was formed, ensures that each partner is individually responsible for reporting and paying tax on their distributive share of the partnership's income. The declaration provides the FTA with the necessary information to assess whether the partnership and its partners meet the criteria for this specific tax treatment under UAE law. Information sharing arrangements between the foreign jurisdiction and the UAE. Another important factor that the foreign partnership must consider is the requirement for adequate information sharing arrangements between the foreign jurisdiction and the UAE. This is particularly relevant in the context of global efforts to combat tax evasion and ensure transparency in cross-border taxation. The UAE requires that the foreign country or territory where the partnership is established and the UAE have effective arrangements in place to share tax-related information. These arrangements typically involve the exchange of tax information regarding the partners in the foreign partnership. Such information sharing agreements are often governed by international standards, such as the Common Reporting Standard, CRS, which facilitates the automatic exchange of tax-related information between countries. The need for these arrangements ensures that the UAE authorities can verify the tax status of the partners and ensure that the partnership's tax treatment is in compliance with both UAE tax law and international tax agreements. Application to be taxed at the partnership level. While the default treatment of a foreign partnership that meets the above conditions is to be regarded as an unincorporated partnership, the partnership may opt for an alternative tax treatment by making an application to the FTA. If the foreign partnership wishes to be treated differently, it may apply for the partnership itself to be treated as a taxable person under UAE tax law. This means that instead of the partners being taxed individually on their distributive shares, the foreign partnership would be subject to tax on its taxable income as a separate legal entity, just like an incorporated partnership or a corporate entity. This election to be taxed at the partnership level is a decision that must be made in accordance with the UAE tax law, and it is subject to approval by the FTA. If approved, the foreign partnership would be treated as a separate taxable entity for UAE corporate tax purposes, and the partners would not be individually taxed on their distributive share of the partnership's income. For more details, contact us.